Hey guys, it's Alex here. Today I'll be giving a short demo into petty cash and the associated petty cash fund. Before we dive into how petty cash works, let's first take a look at what it is. Petty cash is a determined set amount of cash in hand that is used to pay for minor expenses. This might be, for example, stationery such as pens and notepads. Although they're a minor amount in which writing a check would become arduous, ultimately they're necessary to the operation of a firm. So how then is petty cash made safely accessible? The internal control put in place is a petty cash fund, which makes cash accessible to employees either through their own action or an authority that monitors. In its physical form, picture may be a safe or a jar of money. So now we have an idea of what petty cash is and the associated petty cash fund. Let's take a look at the steps involved. Firstly is establishing the fund. Secondly is making payments from the fund. And thirdly is replenishing the fund. Let's go to the first step of establishing a fund using an example. Suppose Metro One Kebabs wrote a $100 check, cashed it to establish a petty cash fund, and gave it to a designated custodian, who in this case is Mary. This means making an initial entry into the general journal to assign the value for the fund. For this entry, notice that petty cash is debited and cash credited. Once the fund is established, how do we make a payment though? It could be done in two ways. The most common way is for an employee to ask for the custodian for funds when purchasing and giving the receipt back to the custodian. Another way can entail an employee spending their own money and seeking a reimbursement. In all cases, it is important for the custodian to collect all receipts as no journal entries are made. So then how are purchases recorded and what if funds are running low? That brings us to finally replenishing the fund. These are where purchases are recorded. To do this, a petty cash fund replenishment report is created to calculate the total amount to bring the fund back to its original balance in addition to total receipts. For example, in a petty cash fund of $100, less remaining in the fund is $15 and the cash required to replenish the fund is $85. When the receipts are read, hopefully the amount matches with the required replenishment amount, like here. When a check should be cashed for $85 to replenish the fund and record expenses in a general journal entry. This increases the all expenses accounts and credits a cash account. So what if the required replenishment amount and receipts don't match up and there is a discrepancy? This could possibly be due to incorrect change or the improper collection of receipts. This is where the temporary expense account cash over and short comes in. Here the discrepancy is charged and the account can either have a credit or debit balance depending on the situation. For example, in Metro One Kebabs, the amount required to replenish funds is higher than the receipts, which means it is cash short. The $2 is then added to the cash and short account as an increase to expenses as a debit.